All right, highlight to begin a week is simple. One of the things that are simple but not basic is coming in when you prepare for a day. What was the overnight range? What's the overnight volume? Where are you at in context? All right. Still in August. It's a Monday. We got some big numbers that are ahead of us. ISM tomorrow, unemployment numbers Friday. And we're kind of slow last week. And we're in this grind up and away. And the volume was pretty low coming in. So you see this yellow box I drew. Not a surprise when you do just the simple stuff at those things to have an expectation that's accurate. So you don't become a hog looking for big winners. You don't overtrade. A rule of thumb is the more volume that the particular contract you're trading is doing, maybe the more volume personal you should have. If it's a low volume day and you look at your personal volume and that's high, you probably got nothing to show for it. You're probably done or down and or buried in commissions and got chopped up. That's over trading. When you got low volume in a market, but your personal volume is above average. You could know that going into the session before the open instead of having to wait all the way to here when maybe it's too late. Right in here, I didn't take it, but it was kind of a slow, ugly head fake. This was the consolidation. This was the leak to the VWAP. The VWAP was coming in, volume weighted average price. It's like a moving average, only better. Couldn't get through there, but you don't know it's going to go all the way down to 90. The only thing was, we had said the middle of that box is important. It gets through there, it could leak lower. And I told the room, I'm not getting short, but I'm certainly not getting long. And so the lesson is, don't be stuck long from up here. If you were thinking it was going to go up, don't be stuck long as it starts to move through the center of this box, because it did get through the top of it a little bit. So you start looking at the center of an identified box. And so you don't necessarily have to be short, even though some guys caught this on the short side. The key is not to be long. Stay off the wrong side, especially on a slow day where you might get small winners and then all of a sudden you're holding on to a trade and it's a big loser and you're on the wrong side of the best move of the session. And I want people to always think of a big boulder, and you got a bunch of people pushing on this boulder, and they really got to work hard, and there's dozens of people pushing on it just to go a couple inches. And then once you get that boulder over a certain point, it flies down. It takes forever to go a foot, and then it goes 1,000 feet in seconds. That's like a chart or a market's price. It takes forever to break out. And then there was just a moment was able to clear and gravity took over. It has everything to do with when there's light volume, that means there's less positions. When there's less positions, that equals less people stuck. When less people are stuck, there's less chasing. Markets move because people generally have to exit, not enter. You get movement, quicker movement, follow through movement when you get more people exiting a position, not trying to enter it. There's always more emotion on the exit, especially if you are down and you're losing money or you're losing in the position. People exiting losing positions always create a little bit more emotion and whatnot. So keep that in mind and always identify consolidation boxes when reading a chart. It's like chart reading 101, and a lot of people don't get around to.